Gold just crashed through 4,500. Silver just crashed below 70. And right now, refineries across the entire Gulf region are literally on fire. Saudi Arabia, Qatar, Kuwait, UAE, all of them burning. This is not a metaphor. This is not a chart pattern. Actual oil refineries and gas facilities across 4 countries are on fire right now because Iran just launched the most devastating energy attack in the history of the Middle East. And the financial markets responded by dumping everything. Gold, silver, stocks, crypto, $7.5 trillion wiped from global markets. And the question that everyone is asking right now, the question that brought you to this video, is whether this is 1979 all over again because the pattern is identical. And if it is 1979, gold has another 47% to fall from here. I am going to answer that question, not with opinion, with data, with the chart, with the actual numbers. And I am going to give you the exact support levels I am watching for gold and silver so you know where the potential floors are. Stay until the end because the conclusion I reach is not what you expect. Welcome to the hidden economy. Hit subscribe and hit the hype button right now. This is the most important video I have ever recorded. Let me start with what happened in the last 48 hours, because the scale of the escalation is unlike anything I have covered on this channel. Israel struck South Pars. That name might not mean anything to you. So, let me explain what it is. South Pars is the largest natural gas field on Earth. It sits offshore in the Persian Gulf, and it is shared between Iran and Qatar. 80% of Iran's electricity comes from natural gas, and Israel just hit it. That is not hitting a military base. That is hitting the energy supply that keeps the lights on for 90 million people. And Iran's response was immediate and devastating. Iran launched a coordinated attack on energy facilities across the entire Gulf region. Not one country, not 2. 4 countries hit simultaneously. Let me walk you through each one because the scale is staggering. Qatar, Iran hit the Ras Laffan industrial city with missiles. Ras Laffan is where Qatar Energy operates the world's largest LNG export facility. Qatar supplies 20% of the world's liquefied natural gas. The missiles caused what Qatar called sizable fires and extensive further damage. Production was already halted from earlier attacks. Now the facility has structural damage that could delay getting supplies back online even after the war ends. Qatar expelled Iran's military attachés within 24 hours and called the attack a direct threat to national security. 20% of the world's gas supply is now at risk of long-term damage, not temporary disruption, long-term structural damage. Saudi Arabia. Iran hit the Samref refinery in Yanbu. This is a joint venture between Saudi Aramco and ExxonMobil on the Red Sea coast. And here's why this matters so much. Yanbu is Saudi Arabia's only remaining export outlet for crude oil. The Strait of Hormuz is closed. The port of Fuera in the UAE has been under repeated attack. Saudi Arabia had been rerouting all its oil exports west through Yanbu to avoid the war zone, and Iran just hit the one facility they were using to get oil out. Iran also launched a ballistic missile toward Yanbu, which was intercepted. Saudi Arabia's foreign minister said what little trust there was before has completely been shattered. When Saudi Arabia says trust with Iran is shattered, the diplomatic path to ending this war just got significantly longer. Kuwait, Iran hit the Mina Al-Madi and Mina Abdullah refineries with drones. Both caught fire. Mina Al-Madi is one of the largest refineries in the Middle East, with a capacity of 730,000 barrels per day. Both facilities are now dealing with fire damage during a war that has no end in sight. UAE authorities shut down the Habshan gas facility in the Bab oil field after intercepted missiles sent debris into the facilities. Habban is one of the world's largest gas processing complexes, 5 plants with a total capacity of 6.1 billion standard cubic feet per day. Shut down. Not damaged and running at reduced capacity. Shut down. The UAE has been the most targeted country since the war started. 334 ballistic missiles, 15 cruise missiles, 14 drones since February 28th. Those numbers are not from a movie. Those are the actual numbers reported by the Emirati Defense Ministry. In 3 weeks, Iran has fired more missiles and drones at the UAE than most countries face in an entire war. The scale of this attack campaign is without precedent in modern warfare. I have been covering this war since day one, and I want to be honest with you. The escalation in the last 48 hours has exceeded anything I expected. When Israel struck South Pars, I knew Iran would retaliate. But I did not expect them to simultaneously hit energy infrastructure across 4 countries in a coordinated wave. That is not retaliation. That is a strategic decision to destroy the entire Gulf energy infrastructure. And if that is what Iran has decided to do, this war is going to last much longer and cost much more than anyone is currently pricing in. Iran issued evacuation warnings before the attacks. They named specific facilities: Samref in Saudi Arabia, the Jubal Petrochemical Complex, the Al Hosn gas field in UAE, the Mased complex in Qatar, Ras Laffan. They gave warnings, and then they struck. This is not random violence. This is a systematic targeting of the entire Gulf energy infrastructure in retaliation for the South Pars strike. And the political fallout is accelerating the crisis. Trump warned Iran that if they attack Qatar's LNG facilities again, he will massively blow up the entirety of the South Pars gas field. That is a direct threat to destroy the energy supply of 90 million people. Qatar expelled Iran's security and military attachés and gave them 24 hours to leave the country. They declared them persona non grata. Qatar is a country that hosted nuclear negotiations between Iran and the US just weeks ago. They were the mediators, and now they are throwing out Iranian diplomats. When the mediators turn into enemies, the path to a ceasefire disappears. Saudi Arabia's foreign minister said they reserve the right to act militarily against Iran. Saudi Arabia, the country that has been trying to stay neutral, the country that has been quietly rerouting its oil exports to avoid the conflict, is now saying it reserves the right to military action. That is a new belligerent entering the war. If Saudi Arabia takes military action against Iran, this war spans from a US-Israel operation into a regional war involving the entire Gulf. And a regional war involving the entire Gulf means oil does not come down. It goes higher, much higher. And here's what I keep thinking about. This war was supposed to last a week. Trump said the objectives were pretty well complete in the first week. We are now 3 weeks in. Refineries are burning across 4 countries. The Strait of Hormuz is still closed. Oil is above 118, and new countries are being drawn into the conflict every few days. North Korea fired missiles last week. Saudi Arabia is threatening military action this week. Qatar just broke diplomatic relations with Iran. This war is not winding down. It is expanding. And expanding wars do not produce lower gold prices in the long run. They produce higher gold prices after the liquidity crisis ends. And here is what this means for the financial markets. When the energy infrastructure of 4 countries is under attack simultaneously, the institutions that hold gold and silver do not think about safe havens. They think about liquidity. They need cash. They need dollars. They need to cover margin calls on their oil positions that just moved 10%. They need to cover losses in their stock portfolios that are crashing. And the fastest way to raise cash is to sell the most liquid assets they hold, gold, silver. That is why precious metals are crashing while the world burns. Not because gold is less valuable, because institutions need cash more than they need gold right now. That is the liquidity crisis in action. Let me explain how this works in practice, because I think it is important for people to understand the mechanics. A large hedge fund holds a portfolio with stocks, oil futures, gold, and silver. The war escalates. Oil spikes to 118. Their oil position goes up, but their stock positions crash. The crash triggers margin calls. The fund needs to post more cash or sell positions. They cannot sell the oil because the war is making it more valuable by the hour. They cannot sell the stocks because the market is locked limit down. So they sell gold. Gold is liquid. Gold trades 24 hours. Gold can be sold in any size instantly. Silver too. The sale has nothing to do with what gold is worth. It has everything to do with what the fund needs right now. Cash. Multiply that by 1,000 funds, all doing the same thing at the same time, and you get a gold crash from 5,400 to 4,500, while refineries burn across 4 countries. The selling is not rational. It is mechanical. And mechanical selling creates the best buying opportunities because the price disconnects from value. Gold at 4,500 during the most devastating energy crisis in modern history is not a fair price. It is a liquidation price, and liquidation prices do not last. Now, let me address the question that everyone is asking. Is this 1979? Pull up the comparison chart on screen. On the left, you see gold during the 1979 Iran crisis. On the right, you see gold in 2026. The pattern is identical, eerily identical. In 1979, Iran went to war. Oil prices doubled, gold surged to an all-time high, and then gold crashed 47%. In 2026, Iran went to war. Oil prices more than doubled. Gold surged to an all-time high of 5,600, and now gold is crashing. The pattern overlay is nearly perfect, and that is what has people terrified, because if the pattern plays out completely, gold still has a long way to fall from 4,500. But here is where I break from the fear narrative, because I do not think 2026 is 1979, and I'm going to tell you why. In 1979, gold had just completed a parabolic blow off top. It went from $35 to $850 in less than a decade. That was a 2,400% move, fueled entirely by speculation and the collapse of the gold standard. There was no physical shortage. There was no industrial demand. There was no central bank buying. It was pure speculative mania. And when the mania ended, the price collapsed 47% because there was nothing underneath it. No floor, no physical demand, just air. In 2026, the situation is completely different. And I want to walk through the differences point by point because this is where the fear narrative falls apart. First, the magnitude of the rally. Gold went from 2 swart to 5,600. That is a 180% move, not 2,400%. The rally in 2026 is less than 1/10 the size of the 1979 rally in percentage terms. Blow-off tops happen after 20x moves, not after 1.8x moves. The math does not support a 47% crash from a rally this size. Second, the demand structure. In 1979, gold demand was almost entirely speculative. Retail investors and speculators were piling in with leverage because gold was going up every day. There was no institutional framework for holding gold as a reserve asset. Central banks were actually selling gold. Today, the demand structure is the opposite. Central banks have been buying gold at record pace for 3 years, over 1,000 tons per year. China has been buying for 15 consecutive months. BRICS nations are actively building gold reserves as an alternative to the dollar. This is strategic demand, not speculative demand, and strategic buyers do not sell during a crash. They buy more. Third, the physical market. In 1979, there were no vault drain concerns, there was no Shanghai premium, there were no exchange halts, there was no lease rate crisis. In 2026, the COMEX has been draining for months. The SHFE is down to 9 million ounces. London froze in October. The CME halted twice. The LME halted. Monetary Metals is paying 12% to lease silver. The physical market in 2026 is under more stress than at any point in modern history. That physical tightness creates a floor that did not exist in 1979. Fourth, the macro environment. In 1979, Paul Volcker was about to raise interest rates to 20%. That killed gold because suddenly you could earn 20% risk-free in a savings account. Why hold gold when you can earn 20% in cash? That was the death blow. In 2026, the Fed funds rate is nowhere near 20%, and the Fed cannot raise rates because the economy is cracking from the war. They are trapped. There is no Volcker moment coming. There's no 20% rate that kills gold. The macro setup in 2026 is bullish for gold, not bearish. So when someone shows you the 1979 chart overlay and says gold is about to crash 47%, ask them these 4 questions. Is the rally the same magnitude? No. Is the demand speculative or strategic? Strategic. Is the physical market tight or loose? Tightest in history. Is the Fed about to raise rates to 20%? No. 4 questions, 4 answers, all pointing to a different outcome than 1979. So what do I think happens? Instead of a 47% crash, I think gold enters a sideways range, a clearly defined range with a top and a bottom. The top has been defined by the 5,400 to 5,600 area. The bottom was defined in late January when gold crashed from 5,600 to 4,400. That 4,400 level held. Gold bounced from there to 5,400, and now it is pulling back again to 4,500. Here are the exact levels I am watching. 4,500 is the first support. This is where gold bounced last week. It needs to hold here or silver is going to get very painful. 4,300 is the yearly support. If 4,500 breaks, this is where I expect the next serious buying to come in. This was the recovery point from the January crash. And 4,000, that is the major level. If gold somehow reaches 4,000, that is where the rally absolutely must hold, or the entire bull market structure comes into question. I do not think we get there, but I want you to know the level exists, so you are prepared for any scenario. Silver. Silver has broken below 72 and is now trading near 70. In this environment of panic selling and liquidity crisis, silver gets hit harder than gold because it is a smaller market with less liquidity. The $64 low from the previous crash is now the obvious target. That was the washout level. If silver reaches 64 again, it would be a retest of the previous low. And retests of previous lows and bull markets tend to hold. They do not always hold, but the probability favors a bounce. And here's what keeps me grounded through all of this panic. One of the most accurate structural analysts in the precious metal space, someone who has called every major breakout and correction in this cycle, is currently predicting that silver will hit $200 by September. $200 in the middle of all this carnage, all this panic, all these refineries burning. The structural analysis says silver is going to 200 within 6 months. I'm not saying that prediction is right. Nobody knows what happens in 6 months. But I'm saying that if you zoom out from the daily chart and the hourly panic and the burning refineries and look at the structural setup, the bull market in precious metals is not over. It is being interrupted by a liquidity crisis caused by the most devastating energy attack in modern history. Liquidity crises end. They always end. The cash gets raised. The margin calls get covered. The forced selling exhausts itself. And then the market reprices based on fundamentals. And here's what the fundamentals say right now. Inflation is the hottest in 3 years. PPI came in at more than double the forecast 2 days ago. Oil is above $118. Food prices are surging with vegetables up 49%. The Fed cannot cut rates because inflation is raging. The Fed cannot hike rates because the economy is cracking. The dollar is strong now because of the liquidity scramble. But the fundamentals underneath the dollar are terrible. 38 trillion in debt, a trillion every 100 days, a trillion a year in interest alone. The war is adding billions per week in defense spending. None of those fundamentals say gold should be at 4,500. All of them say gold should be higher. And the physical market has not changed one bit during this crash. COMEX vaults are still draining. 2.8 million ounces of silver left on Monday alone. JP Morgan pulled 1.6 million ounces from their own vault. The 12% lease rate is still active. Shanghai is still at a premium. The SHFE still has 9 million ounces. The physical shortage did not disappear because the paper price crashed. If anything, the crash is making the shortage worse because lower prices increase physical demand from bargain hunters while reducing mine supply incentives. The lower the price goes, the tighter the physical market gets. And the tighter the physical market gets, the more explosive the eventual recovery. This dump is not about gold being overvalued. This dump is about institutions desperately raising cash in the most violent energy crisis since the 1970s. And when the cash raising is done, the same institutions are going to look at gold at 4,500 and silver at 70, and they're going to buy it all back because they are not stupid. They know what inflation does. They know what wars do. They know what negative real rates do. They sold because they had to. They will buy because they want to. And the buying will come at prices much lower than where they sold. That is the opportunity in the chaos. I'm not going to tell you the bottom is in today. It might not be. The refineries are still burning. The war is still escalating. The dollar is still strong. The forced selling might continue for days or even weeks. But I'm going to tell you that this is not 1979. The structure is different. The demand is different. The institutional commitment to gold is different. And the sideways range between 4,400 and 5,600 is the most likely outcome, not a 47% free fall to 2,500. A range. And ranges create opportunities for accumulation at the bottom and profit taking at the top. I want to say something directly to the people who are watching their portfolios bleed right now. I know what this feels like. I watch these charts every single day. I see the numbers turn red. I see the percentages stack up. And I feel the same knot in my stomach that you feel. The difference is that I have been through enough of these crashes to know that the feeling is temporary. The panic is temporary. The forced selling is temporary, but the gold in your safe is permanent. The silver in your stack is permanent. The physical metal does not care about PPI numbers or margin calls or burning refineries. It sits there being real, being scarce, being valuable. And when the panic ends and the institutions come back to buy what they sold, that metal is going to be worth more than you paid for it. Not because of hope, because of math, because of supply and demand, because of 3.9% core PPI, because of $108 oil, because of a Fed that has no tools left. Every crash in this bull market felt like the end. Every single one. The January crash from 5,600 to 4,400 felt like the end. Silver crashing from 121 to 64 felt like the end. And every single time it was not the end. It was a reset, a shakeout, a transfer of metal from weak hands to strong hands. And then the market went higher. I cannot guarantee that happens this time. Nobody can. But the pattern is repeated so many times in this cycle that ignoring it requires more faith than following it. The levels are clear. Gold 4,500, 4,300, 4,000, silver 70, 64. Those are the zones. Watch them. Do not panic. Do not sell into extreme fear. And do not believe anyone who tells you with certainty that this is 1979 because the data says it is not. Drop a comment. Tell me if you think gold reaches 4,000 or holds 4,500. Tell me if the refinery attacks changed your view on the war. Tell me if the 1979 comparison scares you or if you see it differently after this video. I will pin the best analysis. Share this video with someone who is panicking right now. They need to see the 1979 comparison properly. They need to understand why this is a liquidity crisis, not a gold bear market. And they need the support levels so they know where to watch instead of panic selling into the abyss. If you are new here, hit subscribe. I cover every crash, every rally, every vault drain, and every war escalation, and what it means for gold and silver. Links in the description. This is the hidden economy. Gold at 4,500, silver near 70, 7.5 trillion wiped from global markets. Israel struck South Pars, the largest gas field on Earth. Iran retaliated on 4 countries simultaneously. Qatar's LNG facility extensively damaged. 20% of world gas supply at risk of long-term disruption. Saudi Arabia's only remaining oil export route hit at Yanbu. Saudi foreign minister says trust is completely shattered and reserves the right to military action. Kuwait's largest refinery is on fire. UAE's biggest gas complex shut down after 334 ballistic missiles and 1,700 drones since the war started. Qatar expelled Iranian diplomats. Trump threatening to destroy South Pars entirely. Brent crude at 118. PPI more than double forecast. Core PPI 3.9% fastest in 3 years. Rate cuts dead. The Fed trapped. Fear and greed at 18. And the entire precious metals market crashing, not because gold is worth less, but because institutions are scrambling for cash in the most violent energy crisis in modern history. Is it 1979? No. The structure is different. The demand is different. The institutional commitment is different. This is a liquidity event inside a bull market, not the end of a bull market. The levels are clear, the data is clear, and when the panic ends, the fundamentals will reassert themselves. They always do. Follow the data, not the